Welcome everyone to today's update. I'm Adam Sweet. I'm a principal in our National Tax Office. I sit in Spokane, Washington. My primary focus is pass-through entities, partnerships, and S-corps, but also been part of our SBA working group. And I am led by one of my fellow NTO partners, Jim Donovan, who is part of our R&D tax incentives group, but he's also leading the charge on the employee retention credit. So that's what he'll be talking about today. And then Mel Schwartz, who is our Director of Legislative Affairs out of our DC office, and he's going to be talking about some of the tax extenders stuff that was passed a few weeks ago. So with that, I think we will dive right into it. Here's our agenda for the day: the new PPP legislation, the ERC, and then the extenders. The PPP, I did a webinar last week on the PPP, or 2 weeks ago on the new PPP. So I'm going to do this more in brief today, and maybe at the end of it, try to tie it into a few things people can be thinking about in regards to the employee retention credit, which Jim will cover in detail after me. But let's just kind of start. I mean, first of all, we have new legislation. Last time I talked with you, the president hadn't signed it into law. We had to wait a week, but the president did sign it into law as of last Monday. So it is now final. And maybe a couple of highlights there. The first big highlight is that the PPP expenditures are tax deductible, despite what the IRS said. Congress said it, they've clarified it, which I think in perhaps congressional language, that means that was their intent all along. But PPP expenditures are tax deductible, whether it was a loan you took out back in March of last year, whether it's a new loan. Your expenditures that give rise to forgiveness are tax deductible. And as before, forgiven loans are not taxable. So put those two things together, it means no tax effect. You get the loan, it's free money on the front end, and then on the back end, it's tax deductible. In my mind, that's the right answer. You could argue about, is that deserved, not deserved? Who knows what that means? Is that a double benefit? You know, that's kind of beyond my pay grade, but I would just say, I think that to me, that was always the intent. So it's nice that we have that now codified. For partnerships and S corporations, there's a special rule that says that the forgiven loan proceeds are treated as tax-exempt income. Why is that helpful? Well, it raises your basis if you're in a partnership or an S corporation. If you're a partner or an S corporation shareholder, your basis is raised if you by your share of tax-exempt income. Now, one thing that's come up though is for many or even most borrowers, I would guess their loans are not going to be forgiven by the end of 2020. They're going to be forgiven probably at some point in 2021. So if you're closing the books on your S corporation or your partnership, and you have these PPP expenditures that you now know are tax deductible, but if the loan is not forgiven until 2021, do you have, technically under the statute anyways, you don't have tax exempt income until the loan is forgiven in 21. Does that create a basis mismatch issue for the 2020 tax year? Possibly yes, possibly no. One thing to think about is the IRS has already told us in a rev rule and then in a notice that the IRS considered the PPP loan proceeds to be similar to tax-exempt income, whether forgiven or not. That's what they said in the revenue ruling a couple of months back, that deny the deduction. So does that give you ammo maybe to treat the PPP loan proceeds as tax-exempt income for 20, even if the loan's not forgiven until 21? Maybe there's some meat on the bone there, but certainly some things to think about for partnerships and S corporations that distribute out all their cash every year, meaning that the partners and the shareholders, if they have very low basis coming into the year, this is going to be something that you're focused on here, because you're going to need that basis to pull out the cash or to claim the deductions tax-free. And then I've had this question a couple of times come up, but yes, it applies. This rule is applicable both to first round PPP loans and then also to second round PPP loans, which we'll talk about here in a second. So specifically to this new round of funding, the new legislation creates what's called Paycheck Protection Program second draw loans for eligible entities, and it expands the list of qualified borrowers. So everyone's first question is, well, what is an eligible entity, or how do I get this second draw loan? Well, eligible entity is a pretty expansive definition. I put some of the examples here. This is by no means meant to be an exclusive list. 501c6 organizations are also included in the second round here that weren't included in the first. So, and there's also some special grant, it's under the PPP, but some special grant programs. I think it's called the Shuttered Venue Grant, and I don't have that exactly right, but there's an expanded list of entities that are eligible, and just included in that are what I have on the list here, as well as 501c6, also theaters, independent movie theaters, etc., are covered by this shuttered venue. But putting that all aside, what are kind of the relevant tests? Well, the first round of PPP was about having not more than 500 employees to be eligible. They've kind of ratcheted this down or reduced it down. Now you can't have more than 300 employees to be eligible. And then in the first round, you didn't have to show any reduction to your business necessarily, and you had to certify that you needed the loan due to the economic uncertainty caused by COVID. But now Congress has said you need to demonstrate at least a 25% reduction in gross receipts in one of the 3 quarters of 20 as compared to 19. And then also they said for applications submitted after 1/1/2021, you can use your 4th quarter gross receipts, which is, this is going to be everyone because no one's been able to submit an application yet for a second draw loan. So effectively you can choose a quarter in 2020, first, second, third, or fourth quarter of 20, compare it to the same quarter of 19. And if there's been at least a 25% reduction in your gross receipts, gross revenue, not net, then, and you have not more than 300 employees, then you could be eligible. I know everyone's thinking, well, what does gross receipts mean? We don't know. We don't know if that's a tax basis concept. Is that an accounting and accrual concept? We just don't know at this point. We need guidance from the SBA. Hopefully, we're going to get that guidance pretty quickly here. So stay tuned for that. And then there are rules. If you weren't in business in 2019, there are some rules that you can still make use of the program. But if you weren't in business as of February 15th, 2020, you're not eligible for the second round of PPP loans. Another difference here, the first round of PPP loans, you could get a loan of up to $10 million. It was the lesser of 2.5 months of payroll or $10 million. Again, similar to they brought the 500 employee standard down to 300 employees. They've also brought the maximum loan from 10 million to 2 million. So it's still 2.5 months of payroll, but it's 2 million or 10 million. Those are your limiting factors right there. And you can use, when measuring payroll, you can use either your 1-year rolling period or 2019 calendar year. And similar to last time, there's special rules if you're a seasonal employer for how to measure that. We're not going to get into it here, but there are the affiliation rules to pay attention to. So when you're measuring both 300 employees and as well as some of the other tests, you have to take into account affiliation. So 2 businesses could be grouped together for purposes of the 300 employee test. And I would just say the affiliation rules for SBA are pretty loose. In the tax world, we think about common control as being 50% or more than 50% ownership. It's certainly a lesser standard for SBA. You can have common control over governance. You can have common ownership. It doesn't even necessarily have to be 50% to be treated as affiliated. So we had those rules before. We have those rules again for the second round. So pay attention if you have multiple businesses under some sort of common control. So generally, most borrowers, you do 2.5 months of payroll or 2 million. If you are an NAICS code 72 entity, think restaurants and the hospitality sector, you can actually use 3.5 months of payroll or 2 million for purposes of determining your maximum loan amount. So you get an extra month of payroll up to $2 million if you use the NAICS code 72 as part of your classification. If you're wondering what that code is, I'd Google it. There's a pretty expansive list you'll find with a whole bunch of sub bullets and sub entities underneath. The forgiveness rules, if you're thinking about, well, if I get the loan, how do I get it forgiven? That's really everyone wants their loan forgiven. It generally tracks to the rules that we already know. So you have to spend 60% of the proceeds on payroll. 40% can go to overhead, qualified overhead. So similar to what we had before, if you took a first round loan, you're eligible for a second round loan. And all they said in legislation is, as long as on or before the expected date on which the covered loan, think the second round loan, is dispersed or released to you, as long as you've used or will use the full amount of the first round loan, you're eligible for a second round loan, second draw loan again, but you need to meet that heightened requirement there, those 300 employees and the gross receipts test. If you're applying for a loan of up to $150,000, there's simplified application procedures called for by the legislation. We don't have these forms yet, so I don't know what this is going to look like, but this is what Congress told us to expect. So if you're a smaller business or don't have a lot of payroll, it may be a lot easier to get a loan this time around than it was the second time around. But again, if you're above 150 grand, you're going to be subject to the existing rules or the existing application rules. So I would think the application form for everyone above 150 grand may look similar to the way it looked back in the spring of 2020. Eligible expenditures, again, as I mentioned before, 60% needs to go to payroll. We have the same list of previously qualified expenditures, covered rent, mortgage, utilities, et cetera. They also gave us some new categories of qualified expenditures, and I won't go into too much detail on these, but we have it listed out here. This is the truncated definition here. So if you think this applies to you, I'd encourage you to seek out the full definition. But both new borrowers and existing borrowers can use these new categories of expenses. I guess it doesn't seem very helpful though for an existing borrower, because most existing borrowers, their covered period's already ended and they've probably already applied for forgiveness at this point. And to our knowledge, there's no way to amend an application if you've applied for forgiveness. So it's going to be pretty tough for a borrower to make use of these new categories on first round loans. But nevertheless, if you haven't applied for forgiveness yet, and if you don't think you're going to get full forgiveness, you may be able to look to some of these new categories to help for new forgiveness. So what are some of the procedural considerations? This is probably the most popular topic we get from clients. I had it a whole bunch last week, clients chomping at the bit to apply. We don't have the updated forms yet from the SBA. I mean, we don't even have a form yet for how to apply for the second round. We're going to assume we're going to see these pretty soon. I think Congress gave the SBA like 17 days, or maybe it's 12. I can't remember. There's an expedited timeline Congress called for from the SBA to get stuff out. So we'll see. Also, the legislation itself provides for simplified forgiveness rules for loans up to $150,000. So you're not going to have to provide a bunch of supporting documentation. You're not going to have to do kind of complex calculations in regards to your FTE count and salary reduction and so forth. So we'll see that. We would expect that form to come out as well. And I mentioned the FTE considerations, salary reduction considerations. These are relevant for second draw loans. If you think back to the first round, the way this PPP program works, you get a loan, you add up your eligible expenditures, but if you've reduced your full-time equivalency counts, or if you've reduced certain employee salaries by more than 25%, that can reduce your forgiveness amount. All those rules are still applicable for second draw loans as well. So just a couple of minutes and I'll turn it over to Jim. But one important change is originally the CARES Act enacted the Paycheck Protection Program. The PPP and the employee retention credit were mutually exclusive, meaning that if you took a PPP loan, you could not claim the employee retention credit. Both of those programs key off of wages paid. PPP, 60% of your forgiveness ties to wages. The employee retention credit, it's a tax credit. Jim's going to explain this in in a much more qualified way than I will here, but basically it keys off of wages again to generate a credit. But now the PPP and the ERC are not mutually exclusive. Congress said this. And this is applicable for both first round loans and second round loans. But the important caveat is you cannot double count eligible payroll. So if you have payroll giving rise to PPP loan forgiveness, you can't use that same payroll for ERC purposes. But it raises some interesting planning opportunities. I mean, I think first, up to 40% of your eligible expenditures for PPP can be overhead. So you'd want to sure maximize those, because those aren't, if you 40% overhead, that's not going to jeopardize your ERC eligibility. I think that's of limited use though, if you've already submitted your forgiveness application. But again, think about this, that your expenditures on your application, you can enlist expenditures greatly exceeding your PPP loan, because if you have a 24-week covered period, you have almost 6 months to incur eligible expenditures for PPP forgiveness purposes. So you could tally up expenditures greatly exceeding your loan. All the lender has to do is verify what expenditures give rise to forgiveness. So how is a borrower supposed to know what expenditures generated forgiveness? I don't think anyone quite knows. And that's relevant again, because if you can use wages for ERC, including the ERC program as it existed in the first couple of quarters of 2020, you're going to want to know, was it wages that gave rise to my PPP forgiveness, or was it my other expenses? Because if it's the other expenses, then maybe you can use the wages for ERC. And same comment for second draw loans. And maybe with the added consideration is, should you maybe wait to apply for a second draw loan until maybe the second quarter of 2020, so that you can use your wages for ERC purposes? And I guess all I'd say is, if you're thinking about that, you want to weigh that against the risk of, could funding run out for the PPP program? The first round of the PPP, I think the funding ran out within 2 weeks or 3 weeks. Now Congress did re-up it and refund it, but if you waited for a month or two to maximize your ERC but lost your PPP, that probably is not a good trade-off. Now, I'm not sure this time around, I'm not sure the PPP is going to run out as quickly. You can't borrow 10 million, you can only borrow 2 million, and the pool of eligible borrowers, I think, is presumably smaller at this point, but still something to think about.
Thank you, Adam. As Adam mentioned, my name is Jim Donovan. I'm a partner in our Minneapolis office. Normally, I specialize in R&D tax credits, but I've been leading the effort with the employee retention credit. So today, we'll talk about the ERC and some of the enhancements and the extension to it. For those of you that kind of ignored the ERC because you're like, gosh, you know what, the PPP loan's a fantastic deal, and it was, and you couldn't take PPP and ERC at the same time. A lot of people ignored this part of the statute. So I'm going to hit some of the basics of the credit, and then we'll get into, gosh, what's different about it, what's better about it with the extension and expansion. So the employee retention credit came to life as part of the CARES Act in, March of 2020, and it was set to expire at the end of this year. So it was fairly limited life. And the program certainly hasn't been as popular as the PPP loan, but it incentivizes companies to keep people on the payroll. And because of that, Congress saw fit to extend it into 2021, and then again expand the benefit of the credit. So some of the basics we'll talk about. So it is a refundable credit. It's 50% of qualified wages is the credit rate, and it's a maximum credit of $5K. So if you do the math, that's $10,000 of qualified wages that you can apply that 50% credit rate. And then the credit's used to first offset the employer portion of Social Security tax, but really you could offset all of those payments that you're making on a biweekly basis for FICA, and then any excess is refunded. And really, what we're seeing is basically the 941 had a reconciliation schedule. So if you were go ahead and withholding those payments, that would all reconcile on the form 941, and you'd get maybe some credit back when you filed that, or you got the benefit ahead of time. A lot of our clients, they elected to to say, gosh, I'm going to go ahead and continue to pay that in, and then just apply for the credit on the Form 941. So again, nice benefit. There's a significant enhancement if you were 100 or less employees. Basically, you could take the ERC on all your employees then, versus if you were more than 100 employees, you could only take the credit against those who were not providing services. So you would think about your furloughed employees, or gosh, if you had an overabundance of employees because you weren't providing the same level of service, and you elected to pay them, but they were only working 50% of the time, you could pull in 50% of their wages as for the credit. So again, that under 100 employee level was pretty significant for those that qualified in that case. To be an eligible employer, you had to have a full or partial suspension of business due to a government order. So, if you were a restaurant, for example, just to take some of the bright line examples, and you couldn't open your dining room because the government order shut you down, and you could only do carry out, right, or delivery. You had a government order restricting your commerce. And this could apply to, you looked at hospitals, right, and elective procedures. They weren't able to provide those. That's a suspension of business. So that's one way to qualify. The other way is a bright line test. So you had a significant decline of at least 50% in gross receipts compared to the same quarter of 2019. So if you compared Q2 gross receipts for 2020 compared to your Q2 gross receipts for 2019, and if you had that significant drop in gross receipts, you qualified for the credit. And what's nice about this is you qualify for the whole quarter. Versus if you qualify under the suspension of business, you only qualify during the period of the government order, which a lot of those, for different entities or for different industries ran out in May 31 or sometime in June. So it was a limited window on that. Versus if you qualified under the gross receipts test, you get to take the first quarter and then also or Q2, and then you would also qualify for the next quarter automatically. So again, that was a benefit that was certainly better than under the suspension of business, at least for the 2021. Now we'll talk about how that impacts 2021. I think what I originally said, or what I said, the ERC was set to expire at the end of 2020. That's no longer the case. And, originally you couldn't take a PPP loan with the ERC. So let's talk about some of the enhancements to the credit here. So we have the Consolidated Appropriations Act of 2021, not the most exciting name, but some exciting news here. So first of all, we have 3 retroactive changes, and 2 are really technical corrections. But first up, we have the ability for an eligible employer to take ERC in addition to a PPP loan, right? So the one caveat here is, you can't take ERC on wages paid by forgiven PPP loans. So, that makes sense, right? You can't double dip. But again, the ability to go back and claim the ERC, because like I said, a lot of our taxpayers simply said, hey, you know what, PPP is a better deal, and it is. I'm just going to ignore the ERC. But the reality is, this is now free money. You need to assess whether you can qualify under the gross receipts test or the suspension of business test. But gosh, if you have 100 or less employees, this is something you absolutely should take a look at. If you don't have, or if you have more than 100 employees, then, you probably need to carefully assess, gosh, does it make sense to chase it in 2020, or should I look forward to 2021 where there's some relaxation of the rules as far as qualification? And we'll get into that in a little bit. But like I said, the key here is it's really basically free money if you can qualify. All right, so let's talk about, and I forgot to talk about the expansion of the 2 technical corrections. With respect to tax exempt entities, initially the law was pretty vague as far as, hey, what's the definition of gross receipts, right? And then we got the IRS frequently asked questions, and they punted on it. And then later in June, we actually got a definition and basically said, hey, we're going to follow Internal Revenue Code section 6033 for the definition of gross receipts. And it's nice that they actually put it in the law now. And what does that mean? That's basically what's reportable on Form 990. The other technical correction revolves around healthcare expenses. And so this was a fun back and forth when the IRS frequently asked questions came out on ERC. They basically said, hey, if you're not paying your employees, if they're furloughed, you're not paying them a dime, you can't pull in the healthcare plan expenses as part of that qualified wages, even though they would qualify if you were paying them a salary or an hourly wage, right? But if they're furloughed, gosh, you're not paying them, so they don't qualify. Well, the IRS received a letter from Congress, said, hey, that's not the intent. So they changed the frequently asked question. Basically, what we have here is they're just putting it into the law, which is fantastic for us. No more ambiguity. So again, if you have a furloughed employee, we can pull in those healthcare or health plan expenses for the ERC wages. All right, so talking about the extension of the credit into 2021, they've extended it through July 1 of 2021, so an additional 2 months. So that's fantastic news. They've also reduced some of the qualification criteria. So initially, I told you, gosh, to qualify, we need to hit that 50% threshold, right? Or that drop in gross receipts, or you have a full or partial suspension of business. Well, the problem is we found that not a lot of our clients were actually meeting that threshold. That was a pretty high hurdle, that 50% drop in gross receipts. So Congress must have saw that across the board and said, you know what, we're going to drop that to a 20%. So again, you're still comparing first quarter 2021 back to first quarter 2019. And hey, is there that 20% drop in gross receipts? And if so, you qualify for the quarter. So again, it makes it a little easier to qualify. There was also an interesting point brought up, for employers that weren't in existence in 2019. They had nothing to compare it to, right? And so basically Congress said, okay, that's fine. We will go ahead and say you can use quarters 2020 if you weren't in existence in 2019. So maybe it's a little tougher to meet the gross receipts test if you're a newer company. But again, at least it gives you a path forward. There's also an election that you can make to use an alternative quarter. So for Q1 2021, an employer can use its prior quarter to qualify for the reduction in gross receipts. And so really what you're looking at is if you're an employer of 500, or if you have less than 500 employees, you can basically look back to Q4 and say, gosh, would we qualify with the 20% reduction in gross receipts? And if so, you can go ahead and say, hey, we're a qualify for Q1 of 2021, and then apply for an advance payment. I think that's likely going to be Form 7200, but there's probably going to have to be some modifications to that form to make it work. But basically, it's an opportunity for you to get some cash in your pocket now if you're going to qualify for the credit. So there are some rules around it. You can't exceed 70% of average quarterly wages, and we'll get to why that number makes sense. But again, it's a way to get cash now. If you're going to qualify, again, you can look back at that Q4. So again, just the IRS or just Congress is making it easier to qualify for the ERC. All right. So another thing as far as qualification, initially government instrumentalities were prevented from taking the ERC. So if you were a governmental entity, you were largely out of luck. The extension and expansion of the ERC opens the door for some governmental entities to qualify. So for, in the first round of ERC, what we saw is, gosh, a lot of the private colleges, for example, were taking advantage of the ERC because let's be honest, the online learning is not the same as the in-person experience, right? But what we're seeing here is the legislation opening up that, hey, if you're a separate tax, you have separate tax exempt status, or you're a state college or a university or a hospital, you can now take advantage of the ERC, whereas they were left out in round one. So, again, a lot of these entities, it may be difficult to meet the gross receipts test. But if you have full or partial suspension of business, where you can't have all these in-person classes, you can qualify for the credit. So again, expansion of the credit there, just adding to the pool of candidates in 2021 that can take advantage of the credit. The super exciting news here too is the credit rate is increased. So, I mentioned before it was a 50% credit rate on qualified wages of up to 10 grand. And that was for the year. That was for all of 2020. In the expansion of the credit, we have qualified wages of $10,000 per quarter. So that combined with your 70% credit rate, that's $14,000 per employee if you qualify. And that's in 2021. So that's a huge benefit, just over the 5,000 they offered last year. The other thing that they did that's pretty significant here is they've increased that employee threshold where you can look at taking all employees versus those not providing services, right? So that employee threshold was raised from 100 to 500. So now if you have 500 or less employees, you can take the employee retention credit on everyone, regardless of whether they're providing services or not. Now if you're over that 500 employee threshold, you're limited to just taking the ERC on those wages paid for time not spent providing services. So again, if you have, any kind of a custodian or someone who, they're just not cleaning the building as often because no one's there, maybe you're still paying them full time, but they're working 50% of the time. That would be, we'd pull in that 50%. Again, that's if you're over the 500 employee threshold. The other thing that they did here was in the initial law, they had a 30-day wage limit out there. And basically, this wage limit said, hey, you can't take more qualified wages in the period you're looking at versus what you took in the prior 30 days. So what they were trying to avoid was companies basically bonusing their people to maximize their ERC. And now what they're doing is they're removing that 30-day limit just so bonuses are includable. So again, another nice enhancement to the credit for 2021. All right. So I think this opens the door for a lot of folks, but let's face it, there needs to be a lot of planning that goes into this, right? You can say, gosh, we can go back and you said it's free money, Jim, right? And it is. But there's some hurdles that you want to consider before you say, gosh, we're all in for the employee retention credit in 2020. So first of all, we need to think about how do you qualify for the credit. And if you are qualifying on a quarterly basis, the rules basically state, hey, if you qualify in Q2 of 2020, you automatically qualify for Q3, and you aren't kicked out of the ERC until gross receipts go above 80% of what you had in that quarter versus the same quarter in the prior year. So let's say, for example, you qualified in Q2 and Q3 in 2020, but in Q3, your gross receipts were back up and you're over that 80% threshold, then guess what? You're out for Q4. There doesn't appear to be a way to requalify. So even if your gross receipts drop significantly in Q1 of 2021, the way the law reads right now, you can't requalify for the credit. So keep that in mind in terms of, gosh, if I'm going to qualify in 2021, do I really want to go back and look at 2020? Because in 2021, you're looking at a potentially 14,000 in credit per employee if you can qualify for both quarters and maximize gross or max out qualified wages versus, that's a $5,000 max per employee in 2020. So that's something important to consider. Now, if you're qualifying on the suspension of business, there seems to be no limit. If you qualify, gosh, in April and May because a government order shut my business down, and then you cases spiked in November and December, right? And I had another government order that shut me down. You'd qualify again. So again, there appears to be more flexibility if you qualify under that scenario. But again, there's, you're looking at a limited window of time versus a full quarter. So something to keep in mind. You also have to look at the period of qualification versus, the PPP covered period, right? So when we talk about, you can't double dip on those qualified wages. If those wages were paid by a forgiven PPP loan, we can't pull them in for the ERC, right? So the question becomes, okay, what are my qualified wages for ERC in 2020 if I did take a PPP loan? Can we get enough separation between the covered period and the qualified period? Can we really max out that credit? So again, something to think about with respect to taking advantage of both incentives, and then again also, gosh, do we take this in 2020 versus 2021? The other thing you need to watch out for is interplay with other incentives, because again, we can't double dip. I talked about PPP loans, but if you're taking the R&D tax credit, other employment credits, FFCRA, FMLA, again, we can't use the same wages to take ERC as we are those other credits. So if you took advantage of FFCRA and then a PPP loan, then maybe the ERC is off the table for you. So again, just some things to consider there. The other thing that I will mention is the aggregation rules still apply. And I didn't go into this in a lot of detail, but I know Adam covered it, and it's similar for PPP loans, right? If you are a controlled group of corporations or a group of entities under common control, we have to look at you as a single taxpayer. So, what does that mean for you? Well, gosh, that impacts whether you meet the gross receipts test, because we got to look at all of them, or the number of employees. Again, and for 2020, maybe it puts you over that 100 employee threshold. We have a little more flexibility with the 500 employee threshold for 2021. And let's not understate the potential benefit for 2021. And again, I realize this is a best case scenario, right? But if you had exactly 500 employees and you were able to maximize their wages in each quarter, you're talking about $3.5 million credit for combined for Q1 and Q2, which is fairly significant. And again, you don't have to, with that 500 employee threshold, you don't have to show that they're not performing services. It's just everybody qualifies. So again, could be a huge benefit, and why you'd want to look towards claiming the ERC in 2021 versus 2020. Finally, I guess I don't know all the answers around the new legislation. We're still figuring things out. And we also expect more guidance. What we received in round one were, well, yeah, the Joint Committee of Taxation released some initial thoughts on the ERC, and then we had the IRS frequently asked questions, right? And those came out, I don't know, 2 to 4 weeks after the law did, right? So it might be a couple weeks before we see any guidance. But basically, while we can't legally rely on those FAQs, they do provide a lot of insight into how the IRS views this, and if they ever decide to audit these things, how it would be approached. So I guess long story short, I do anticipate we'll see some guidance here, but it'll likely be mid-January before we see anything. So that's really where we're shaking out with ERC. So again, there's a ton of upside here. You just need to be diligent about whether it's worth chasing in 2020 or whether the enhanced benefits in 2021, whether it makes more sense to go that route. So that's really what we're looking at for ERC. Mel is going to talk to you about a lot of the other provisions in the new legislation.
And thank you, Jim and Adam and Amy, for leading us through that. I think that for most, at least most smaller businesses, the PPP program, the employee retention credit, clearly very, very important parts of this legislation that came through. other parts, COVID related, I think were really where we saw a lot of attention being paid. But interestingly enough, while the public attention was on the question of whether the checks were going to be for $600 or $2,000 or some number in between, and by the way, it did end up at $600. Don't expect anything with regard to the 2,000. Congress did make a very, very significant change with respect to how it approaches expiring provisions. And that's what we typically call the extenders. And we're going to go through this. It turns out there were a lot of provisions addressed here. We're going to need to go through these pretty quickly in order to get to them. So to the extent that you would like to discuss something in more depth, please feel free to put something into the Q&A that it will give us a chance to get back to you, or alternatively, feel free to simply shoot me an email, and we can discuss things further. So without further ado, a key element here is that forever, discussion with respect to the extenders has been, well, why don't we just sit down and makes the ones that we want to keep permanent and let the other ones go? Well, letting the other ones go has never really been on the table, I think. But this time, Congress did make a number of important provisions permanent. And I think one of the key ones that is going to certainly provide some effect for a number of taxpayers is they have taken the efficient commercial building deduction, the 179D, the $1.80 per square foot. If you do a significant improvement to the energy efficiency of your building, 60 cents per square foot if you do something less. And they have made it permanent. Plus, they have taken that $1.80 or 60 cents and will now be adjusting it for inflation. A couple of other changes are made. As building codes are updated, there was some question as to whether or not the statute was being left behind. That language has now been modified so that it will tie into the ongoing increase in or ongoing changes. Some other items you see listed here, the 7.5% AGI floor for medical expenses. It's not going back to 10, and at least for the time being, it is permanently not going back to 10. For those of you who were concerned that your favorite brew pub was about to be shut down because they were going to lose their lower tax rate on the beer, do not worry. COVID is still a problem, but at least the tax on the beer is still going to be reduced, and significantly reduced, with respect to the smaller amounts of production. A few of you may be into the railroad track maintenance credit, the so-called short line credits. This has also been made permanent, although here we see an additional change in that the amount of the credit is going to go down from 50% to 40% for tax years beginning after 12/31/22. And finally, if you're a volunteer firefighter and get a $50 honorarium from the county, you will never have to include that in income. A lot of the changes, or the extensions, do reflect an extension of the alternative energy, we'll call them conservation provisions that are in the code. We already talked about permanency for 179D, the energy efficient business property. But also what we're seeing here are a number of changes, and I'm going to back up here. There we go. That looks a little clearer. Only a 1-year extension for the rule that allows you to essentially claim a Section 48 credit. Section 48 credit is based on the amount that you spend whereas the Section 45 credit was based on the amount of electricity that you produced and sold. There is a 1-year extension of the opportunity to essentially choose between the two. Going beyond that, we see longer extensions with respect to when construction must begin for various types of uh, uh, energy efficient property, alternative energy systems like solar, fiber optic solar lighting, geothermal heat pumps, fuel cells, microtray. You see the list here. All of those which previously needed to be placed in service, or excuse me, construction needed to be begun by 12/31/21, that has now been moved out to 12/31/23. And the same, actually, even better, if you're interested in getting into the carbon dioxide sequestration game, we'll get an extra 2 years there, all the way out to 2025. Now, one question that had come up with respect to the extension here is, would the safe harbors that apply automatically be extended along with these extended dates? Because typically, either you have to establish that you have incurred 5% of your total costs, or you have achieved significant production, or excuse me, significant construction, in order to trigger the idea that construction has commenced for these purposes. And then there is a fixed period of time by which you need to actually complete the work. Congress, or excuse me, the IRS has gone ahead and clarified this. Notice 2021-05 came out, I believe, on Friday. And generally what it does is it extends the safe harbor rules, building into these later commencement of construction dates compared to the earlier numbers which were there. Also, and this is noteworthy, there was specific recognition of either offshore, we'll get to offshore facilities in a minute, to offshore facilities or facilities that are being constructed on federal land, and the likelihood that it will take longer to complete construction. And so with respect to those items, we see in notice 2021-05 a 10-year safe harbor in order to get the rest of the construction completed. Other items in the alternative energy conservation area, second generation biofuel production credit has been moved out for a year. The 10% credit for non-business energy property. And this is you bought an energy efficient appliance and you get a small amount of credit. Okay, we're going to push that out for another year. The credit for residential energy efficient property. This is not a new appliance. This is actually putting in some sort of energy efficient system that now kicks out to 12/31/23. Again, a 2-year extension. Note that these extensions are extensions of provisions that were not scheduled to expire at the end of 2020, yet were picked up and moved along with some of the other energy provisions to establish, I think, fair to say, a firmer ground for taking advantage, for encouragement of these types of expenditures. A couple of other ones to keep in mind, the fuel cell motor vehicle credit and also the alternative fuel vehicle refueling property credit has now been kicked out again. It was going to go till 2021 anyway. Or now it goes until 1/1/2022. So that gives us a 1-year extension. This is the $1,000 credit you get if you've bought an all-electric car for putting a charging station in your garage. It is also for those businesses that maintain a fleet of such vehicles. And it's not just electric. This would also include the compressed natural gas. Then you can get a credit for setting up your own facility for the purposes of refueling. Let's take a look now. Oops. Employment credits. Again, not just a one-year extension, but in this case, a 5-year extension of two of the, I'd say, more important employment credits. Certainly from a political standpoint, the work opportunity tax credit has consistently been one of the reasons that the Democratic Party has willingly gone along with the extension of some things that it probably was not in favor of. The work opportunity tax credit here gets a 5-year extension, as does the paid family leave credit. This is the 45S credit, the credit that was already in the statute. This is separate from the Families First credit, although it's worth noting that the Families First credit, the idea that if you provide paid leave for a person who is sick or a person who needs to care for someone who is sick with the COVID, then the credit for that, and it's a dollar for dollar credit, is extended for 3 months. So for the first 3 months of 2021, if you pay those amounts, or rather you pay with regard to a leave day that is within that 3-month period, then the employer can claim the Families First credit. But there is no extension of the mandate. So it strictly is up to the employer whether they are going to provide that paid leave. If they otherwise would qualify for Families First credit and they provide the paid leave, then at least for the first 3 months, the government will pick up the tab. Now, again, keep in mind, as both Adam and Jim pointed out, we've got wages. We've got the potential to use wages for a lot of different reasons here. And so if you want to claim wage here, then you can't use it for your PPP loan. You can't use it for your employee retention credit. You can only use wages once, or any piece of wage once. So that is always something that you want to look at the details, but certainly be aware that it is there. And if that is something that you on the employer side choose to provide, then it is something that can be taken care of. The New Markets Tax Credit, 5-year extension as well, as is the Empowerment Zone provisions. Couple of others that are more focused on Native Americans. The Indian Employment Credit gets a 1-year extension, and the credit for production of Indian coal gets a 1-year extension. On the individual side, 5-year extension of the exclusion from gross income from the discharge of indebtedness on a principal residence. But note that there has been a significant reduction in the amount that can be excluded. Under the old rules, it was $2 million or $1 million if married filing separately. That is now, for future reductions, going to be reduced to $750,000, half that amount if you're married filing separately, which again is one reason why you generally do not want to file married filing separately. We only get a 1-year extension on the mortgage insurance premiums being treated as qualified interest. And similarly, we only get a 1-year extension on the credit for health insurance costs and the volunteer firefighter and emergency responders provision. Some depreciation changes, important to note. A 1-year extension of the racehorse provision, but a 5-year extension for the NASCAR provision. Again, maybe some question that whether or not you really need the special 3-year recovery period for racehorses, particularly given the fact that we still are going to have bonus depreciation in place. But in any case, It is here. For those of you who have depreciable business property in the eastern half of Oklahoma, there is a clear 1-year extension of the accelerated depreciation on that property. So if you're in downtown Tulsa, you continue to get that benefit. It is probably worth noting here that the Supreme Court has talked recently about expanding or about clarifying the definition of what constitutes an Indian reservation. This was in Oklahoma. This case involved Oklahoma, but I think raises some interesting questions and maybe something worth looking at if you have property on what potentially could be treated as an Indian reservation. We also have the special deduction for film, television, and theatrical provisions. And of course, clearly we're not going to get into the detail of this one, but the exclusion from the foreign personal holding company income. 5-year extension on this one. Now, one thing I think that is worth at least thinking about here is we now have taken off the extender list an awful lot of provisions that in the past were sort of the engine that drove. So it may be that it will not be quite as easy to do extensions in the future. We will have to see. Some other provisions were also thrown in. We talked about energy credits before. They've expanded, so now offshore wind facilities and waste energy recovery property are going to count. Some attention was provided. In fact, yes, business meals in 2021 and 2022 are fully deductible. And with that, I think we have reached the end of our time. As I say, Amy, let me toss it back to you so that we can get that last polling question in. And I want to thank everyone for having joined us today, and certainly encourage if you have any questions or questions that occur to you in the future, do not hesitate to shoot an email to any of the three of us, and we'll see what we can do to clarify things.
No, I just say we had a bunch of questions come through. In regards to the PPP stuff, we just need additional guidance. There's a whole bunch of stuff we don't know about the second draw loans, so I would leave it there. Also, generally, yes, the question was, do the same rules from the first round apply to the second round? Yes, taking into account 300 employees and the gross receipts, but otherwise, yes. The affiliation rules apply. The exception to the affiliation rules still apply, meaning if you're an NICS code 72 or a listed dealership, you can kind of test each independent business separately. So all those same rules still apply, but otherwise all the other detailed PPP questions, we just need guidance from the SBA, and I would expect that soon.
And Amy, I'll add that there were a lot of questions in there about ERC and which rules apply to which year. And so the new credit rate and basically all the enhancements apply to 2021. We're stuck with the old rules for 2020. The big retroactive change is being able to take PPP along with ERC in 2020.
Thank you all so much for attending. I know we're over time, so thank you, Adam, Jim, and Mel. You guys have a great day.
Thank you, everyone.
Take care, everyone.